Hi, and welcome to the first episode of SuperStonks. Today, I want to start with the first company I want to introduce and discuss with you. It's a stock that caught my attention late 2019. It got on my watch list. I didn't invest in it by then. I invested in the company recently in early February 2021. The company is a Chinese pure play in the dating market, and maybe you have came across the company. I want to share the secret with you. It's the Momo company. Momo was founded in 2011 with its first app called Momo, and 2018 it acquired another dating app called Tantan. And so it's basically a two-product company specifically targeting the dating area. So while Momo is basically more like social media and interaction and video, Tantan is basically, I would say, a 95% clone of Tinder. So everybody knows it, and everybody knows how Tinder worked out in the US and everywhere else in Europe. It's a very addictive service, and I'm pretty sure it has a lot of prospects in China as well. But let's start with the basics. And what I want to start with is basically the chart. And the chart looks horrible. It's just, it hurts. It really hurts my eyes. I'm glad I'm wearing freaking sunglasses to filter out this red chart. So, as you can see, there were huge swings up and down. Momo used to provide a lot of momentum, a lot of growth in the past years, especially after 2016 into 2017 into 2018 over 2019 until momentum declined. It stopped. Revenue slowed down. Revenue growth slowed down. The margins declined. And so investors got very disappointed. And the other thing is that in 2019, the company was really a victim of Chinese regulation. They banned one of their apps from the app stores. So investors disappointed there. In 2020, harsh lockdown in China. What happened to the dating industry? You don't want to date when you can't go out. So you probably don't use dating apps. So that's one reason that I think is true, although other services have experienced growth. But what makes the company interesting as well is I like simple companies and I like pure plays. It's just much easier to focus on a very specific area that you can understand, and there's not much distraction from it compared to when you try to figure out how do you evaluate a bank. You basically have no chance in finding out the real value of a bank, because how do you value all the derivatives, all the risk exposure they have? How do you price in all the regulatory issues and so on? So to me, it's always very appealing if I don't need to have an IQ of 250 just to understand the basic fundamentals of the company. And with Momo, I've got a feeling that it's a company that is in my circle of competence, area of understanding. I don't know how you want to call it, but it's simple enough that I think I can understand it. So, that being said, let's dig into the numbers. The numbers are on the first page. I always start with looking at the numbers on the Guru Focus page because it just provides me on a glance the most important ratios, cash to debt, equity to asset, debt to equity, and so on. The most important margins, return on equity, returns on asset. So if there's a green light here, that makes me comfortable because profitability is something that I always, 99% is the critical factor to invest in a company. If the company doesn't earn money, you need a lot of you need to put a lot of effort into convincing me that I still buy the stock. The company has to be profitable at the current levels. It should have been profitable in the past because maybe it's just a cyclical company, it's a turnaround. But you want to know that this company is able to earn money. And if that's not the case, then 99% of the companies I'm looking at that don't earn money, I'm out. The other things are the valuation ratios, price earnings, forward price to earnings ratio. That's important to me because that's where I start comparing the company to other companies. So evaluation means comparison. You want to evaluate the company, you want to compare it to another company. You want to see how a similar company is priced by the market. Why is this one more expensive than the other? You want to figure out the reasons. That's pretty important homework that you got to do. But if you don't do that, then it's just gambling, I guess, putting your money into a stock. And that's where I start. If the numbers or if the ratios get past the first filter, I'm going to dig into the real financials. Why is this necessary? Well, to me, it's necessary because once I'm thinking about putting money into a company, you want to think about what Peter Lynch has said. You want to be able to figure out what's an appropriate price for the shares of this company. Because if you don't know your plan, your game plan. You don't know when to get in, you don't know when to get out, you don't know if you should get in right now, you don't know if you should get out if the price drops. What are you gonna do? If you don't have any metric or any systematic approach to figure out the value of a share, then you have actually no idea, or you can't have an idea on how to react when the price goes down. Do you get out? Do you buy more? Do you just dance around and wait for better times? I have no idea, but to me it's always important to know that when I put money into a stock and the stock price goes down, I usually look for companies where I can buy more shares. And this is also very important, that you need to know what kind of investor you are. Are you short-term oriented? Are you long-term focused? If you're focused on the long term, then basically it makes the whole investment process much easier. So you just have to figure out that you are right, but you don't have to figure out when you have to be right. If you buy options, for example, and you have an expiration date, you need to be sure that you are right, and you have to hope. And I want to put focus on the word hope, because you cannot influence the stock market. You cannot influence other people, big institutional investors. When they pull out the money and the stock price goes down and your option expires in 3 days, you have a serious problem, because then you might have to roll up, roll out, roll down, whatever, roll on the floor, roll your options, roll with your options. Just, it's a game I avoid. I do not like options, but as I said, if you are long-term focused, then time is not the issue. Okay, so Guru Focus starts here with the revenue per share. That's the first thing I don't like. I start with the income statement and the revenue as it is, because revenue per share is influenced by the amount of shares outstanding. So if a company buys back a lot of shares, do the math, revenue per share goes up, even if the absolute revenue went down. So that's the first error here if you don't look at this metric from the right angle. When we see how the revenue has developed over the past years, then we see the plateau here. It went up until 2020, and now it's kind of, it's flat. It actually declined. So That sucks because it takes out a lot of momentum of the stock and the stock price. And so that's one of the reasons why the stock price went down drastically. The next thing I'm looking at is also very, very, very basic. As you can see, it's no rocket science what I'm doing here. It's actually net income. If I see that net income is positive and has stayed positive, even revenues declined, then that's a green flag for me, if you want to call it that. It's a good sign, and I really like profitable companies. So when you scroll down on Guru Focus, you come across the per share data. I skipped that. It's not interesting to me at all because I want to have the absolute numbers. So I go straight to the income statement. Looking at the revenue, as we saw on the chart, it has declined. It has plateaued because from what I guess, the original app Momo has matured. In the product life cycle, you get to a point where there's just not that many new clients, not many more growth or whatever. So at some point, or people are getting more, but they don't use more of the service. So you need to adapt your services you want to provide. You want to come up with new products. How does Momo create revenue? That's I really like the simplicity. Basically, it's video streaming and gifting. So there are talents that produce a lot of content, a lot of video, and if you like the videos, then you can buy gifts on the Momo app. Those gifts, for those kind of gifts, you pay money, and then you can award the talent or the people that making shows that you like with awards. And what happens is, let's say you pay $10 for that fancy digital rocket ship and you give the award to your favorite streamer. What happens is that the $10 that you paid Momo keeps about 60%, so $6, and the rest goes to the streamer or the streamer's agency. So, and that's aligned with the gross margin here. So as you can see, I mean, at the starting point, Momo had a gross margin of almost 60%, and it declined in the past years. Most likely due to competition and so on, because the streamers also want to earn money and they move to platforms where they gotta keep more. As simple as that. So Momo had to struggle a little bit, but they found a solution and made new contracts with their most profitable streamers. So, but as you can see, I mean, it's just in the nature of the business that you are in a competitive environment and you have to make sure that you keep attracting talents, and also you have to pay for the talents because otherwise they move somewhere else. And that's the simple revenue model of Momo. So easy to understand, and it's just cash for digital awards. I mean, it's just money printing, right? That's simple, and it's so genius. I really love it. What do you have on the expense side of a digital media company? It's people, it's wages, it's infrastructure, computers, servers, updates, keeping everything running, keeping anything safe and secure for the users, paying your service providers, your IT technicians, consultants, whatever. And basically that's it. Simple IT company with infrastructure to provide the services. And of course, some sort of marketing expense. That's one important thing. That's one of the biggest expenses that a company like this has to pay. Yeah, and there you go. There goes the operating margin, right? So then there are some small interest income sources for deposited money on bank accounts And we get to that in a bit on the balance sheet. And at some point, when Momo started to turn profitable, the tax rate increased, right? You have the loss carry forward. Once it is amortized, the company has to pay the full amount of tax, and this is about 25%. So there you go, down at the net margin. So for $1 in revenues that the company creates, it can keep 14-15 cents. And I think that's something. That's something, considering that most of the app providers or many growth companies in the app or service industry are not profitable at all. They're just burning cash. They need to refinance. They need to collect new capital on the stock market. They need to issue bonds, whatever, because they are just burning cash to grow. And history just, how do you say, it doesn't really repeat itself, but it rhymes, right? So if you look at the dot-com bubble, it's basically people were investing in companies because they grow and they grow and they grow. And at some point, what do you do when the growth stops and the company is loaded with debt, or just has went on the stock market to just get capital from investors? And what do? If the company is not growing anymore and the company is dying, the only people that have earned money are the ones that have sold their shares for a profit. And if you are left as a bag holder, then sad faces all over the place. So that's that. And that's why I like the income statement of Momo a lot, because it's simple, it's profitable, and the margins are quite okay, considering that it's a mature business and still making profits even if the revenues went down. And I think they will continue making profits in the near future, even if their products or their apps or user base is not growing at levels it used to in the past. Balance sheet is also super simple, because considering that Momo only has cash on its balance sheet, makes it a very simple balance sheet to analyze. So it's just cash, short-term deposits, marketable securities, which is basically cash, right? So there's some small numbers, receivables, it's not worth mentioning, and then you got total current assets. It's that simple. Property, plant, equipment, most likely just IT infrastructure, buildings, whatever. It's a small amount. And here we have a bigger position. That's the Goodwill. In 2018, Momo purchased the 1010 app, and they had to pay for it. I think it was between 700 and 800 million. They paid in cash and with Momo stock for the previous 1010 owners. So Goodwill here, this is just the purchase price of the 1010 app. And there you go, boom, long-term assets. It's really not a complicated company. And since the assets are basically just convertibles and cash and assets that you could sell, in the case of 1010 it might take a little longer, but it's basically not that simple. And if you look at the liabilities, the short-term liabilities and the long-term liabilities, short-term, that's just accounts payable, anything that you see on any other company as well. And here we have a convertible bond, as far as I remember, that expires, I guess, in 2024 or something. But it's basically still a couple of years until the bond expires and they have to pay back the cash or pay back the loan with company shares. But we can take another look, or a more detailed look at that in another episode. But let's leave it for today with these numbers. So basically what you can see, it has a huge equity base. And this is something that I like a lot. And that's something that is very important to me, because once you have a negative equity base, yeah, what does that tell you? That tells you that as a stockholder, you basically do not anything, you don't own anything in case the company gets liquidated. It's just debt, it's just liabilities, and the stockholder basically has no fundamental ownership in anything that that makes the company, except if there are any uh hidden or uh, uh, assets that are carried at cost basis that are just worth a lot more. But I don't know that. It's just why should it be difficult? I like the easy balance sheets, so here that's what I understand. That what's making me feel comfortable. And also, then I like to take a look on the cash flow statement. Cash flow is important. You want to have a company that is able to create cash flow, free cash flow, in order to pay back its liabilities, in order to reinvest its earnings. It can pay out, it can buy back shares, whatever. Free cash flow is super important, and so you wanna have a closer look at that. And this is just wow. I mean, there's nothing to complain about here, right? So, yeah, that's the fundamental analysis I start with. And I think Momo is just a fine example of an easy to understand company, of an easy to understand income statement, business model, a very, very easy balance sheet to understand, a positive balance sheet with a huge equity base and positive cash flows. So this is something that you want to see in a company where you consider putting your money into. And now, since you established some sort of connection for it or with the company, that you know, or that you try to figure out what makes the company tick, what makes the company work, you need to start here. Looking at the price earnings ratio, there you go. Price earnings ratio of almost exactly 10, because it leaves us with a market cap of 2.94 billion. So 300 million times 10 is about 3 billion, right? That's pretty simple there. And before we take a look at the possible liquidation value, where we have to come up with some sort of creative approach, we start with comparison. So the price earnings ratio of 10 is very, very low compared to, let's take an American similar company, Bumble. It IPO'd recently, share price of $55, price earnings ratio of almost 100. That means there's a lot of growth expected and priced into the company and in the current share price. I mean, it has been declining. Excitement, I don't know, in the beginning, and now it's like people are kind of nervous at the moment when it comes to tech companies. And that's another thing why I like Momo, because Momo is valued like a real value company. It seems to me that if I, it's always more attractive to invest into a company where you don't know what the earnings are gonna be, because then there's no metric, no comparison. You can just say, well, it's gonna be worth 100 in a year, it's gonna be worth 150 in a year. Nobody knows, because it's not profitable. But once a company gets profitable, then it's like, yeah, it has matured. It has a price earnings ratio of around 10. That's fair. So yeah, and then the stock price drops, and that it's just nice when you can buy the stock super cheap and having a profitable company, and not have to gamble on non-profitable companies, or basically non-profitable companies that are just super expensively priced, because once growth stops, we saw it on the Momo chart, then the price drops, and you end up being the bag holder, and you want to make sure that you have locked in a lot of profits before the price goes down. So that's one stock. We can also look at a similar company, Match Group, the parent company of Tinder. What do they have in store? Price earnings ratio of incredible, and forward price earnings ratio of 55. It's ridiculous. I mean, it's just why? I try to figure out why that's the reason. I mean, of course, Momo is a Chinese company. It's listed on the US stock exchange. The SEC is enforcing this law that might delist Chinese companies within 3 or 4 years in case they don't comply with their audit rules. So yeah, I know that's a bummer, and people get nervous, and also Chinese authorities and regulators are kind of strict, and so that's kind of, people don't like it, and they are more careful at the moment. So okay, that's a lower price earnings ratio there, but you want to know the intrinsic value and how people value those kind of companies at the moment, because that's what you get. I mean, you can do discounted cash flows all day long, and you can be the best cash flow discounter from here to China. It doesn't matter once, because your stock will be worth what the people are willing to pay for it, and nothing more, nothing less. So I think discounting cash flows is not that important. I haven't discounted one cash flow in my whole life when I was looking at real stocks. So I'm comparing, and to me, US companies in a similar industry are highly priced, very highly priced, compared to a rather attractive company just in a different country that has still a lot of growth prospects, that has an app that might restart the whole growth story of the company. The Tantan app is growing rapidly. It's not profitable. Profitability is from the Momo app. This is the cash cow of the company, leaving just huge amounts of money that can be reinvested in new products, new services, and the more promising app, Tantan. So that's the story for me here. And the fundamentals are great. I really like it. It's simple. It's easy to understand. I think the stock price got disconnected from the intrinsic value. And I think it's just totally underpriced at these levels. From my point of view, the company will get back to growth. I don't know when. I hope it's going to be in 2021. The company got bashed in 2019 when the Chinese authorities banned the apps from the store because of any accusations of promoting prostitution and so on, because there were apparently a lot of people were jumping around naked on the app, and the Chinese government doesn't like that. And so they got banned for 3 months. They cleaned up their ecosystem in the app. They got back on track, and 2020, huge lockdown, harsh lockdown in China. Very, very strict rules there. And why would you use a dating app when you can't go out on a date? At some point, it just gets boring. And what I think is, if you have read the last earnings transcript, the company takes a lot of initiatives to get back on track, clean up the environment, makes the environment and their app ecosystem much more attractive to women. They try to get rid of all, the black sheep on the apps. They try to get rid of fake accounts. They try to make the app more serious and get back on the growth track. And I think these are good initiatives. We might cover it on another episode, much more in detail. But at the moment, the fundamentals look good. They look good to me. Easy to understand. A lot of cash being produced by the matured app. And there's a lot of reserves this company has into its business model as it is in its balance sheet for the next couple of years. And I think we might see a rebound pretty soon. That's what my expectation is, just based on the fundamentals. I hope you share my point of view. I'm not angry if you disagree. Just let me know. Put a comment in the comment section. Write an email, or let's just keep on discussing the stock price, the fundamentals. What's your point of view? Do you agree? Do you disagree? Where do you not agree? And I'm very curious to receive your feedback. So I hope you enjoyed the first episode. I don't know, maybe it just got longer because I just couldn't stop talking, whatever. There's so much to discuss about this stock. And there we go. Hope to see you all soon on the next episode. And leave your comments in the comment section. Take care, everybody.